We'll be with you in just a second. Okay. All right. I wanted to welcome everybody to our webinar today. Chris and Jennifer, can you hear me all right?
I certainly can.
Yes.
Okay, very good. My name's DC Couch. I'm the sales executive for OCI Services. And for those of you that aren't familiar with us, if you're looking at us or at our website for the first time, we're kind of a boutique brokerage firm. We really operate a little bit different than most. I mean, we're not out there trying to get the billion-dollar producers, and what we're trying to do is to get some relationships established where we can help you grow your business, in more of a face-to-face support. We're just not marketing monkeys that are sitting in a cubicle dialing for dollars every day. We truly care about the agent and the agencies, and we're going to try to help you grow your revenue. And some of the things that we offer, we've got case planning assistance. These guys are tremendous at the OCI headquarters. They can really help us with that. In-house marketing support. We've got a tremendous young lady up there that does a really good job with creating marketing pieces. So if you're in need of some of that, reach out to us. We do have impaired risk specialists. We will do your case management. And then obviously, we have the online quoting, we have the online case statuses, and much, much more. So some of the things that we offer here at OCI, just on the solution side, is we have a full line of life insurance. We've got all the companies that you can offer. We're pleased to have John Hancock work with us today. But we've got term and whole life, index, guaranteed UL. We've got hybrids. The disability market, what we have found is really kind of on the rise. We've got some great companies that do long-term and short-term disability. And another product that's out there that is really gaining traction again is long-term care. So we've also got that traditional long-term care if you're interested. Most of our companies offer the LTC hybrid on an individual basis, and a few on the joint. And then we've also obviously got our annuity hybrid products. And then really new to OCI is our annuity portfolio. And I'm just happy to tell you that we've basically got all the good carriers that are out there. It's something that I specialize in. So what we're trying to get our agents to do is to not turn their back on somebody that comes in and says, hey, I tell you what, Bob, I've got $400,000 in this IRA. I don't know what to do with it. Can you help me? We want you to answer the question yes, because we will get in and help them out. So, and then along with that, then we've got a whole other side of our company that does everything health related, and they really do, as most of you probably know on this webinar, they really do a wonderful job. So. With that, I am going to introduce Chris Martin, and Chris is the Regional Vice President for John Hancock. We've had an opportunity to work with Chris, since we've started, since I started with OCI. He does a wonderful job, is very knowledgeable. I did have an opportunity to play golf with Chris, and I will tell you that he's much better Regional Vice President than golfer. We know that, and I think he'd probably say the same thing about me. It's really not our forte. But Chris has got a guest with him that's going to make this presentation. Chris, I'll turn it over to you.
Yeah, DC, I appreciate that. Thanks for the compliment on the RVP job, although I don't know how to take that on the golf side of things. But I think everyone can rest assured neither one of us is going to quit our day job. That's for sure. So happy to be here today. Happy to partner with you guys. And today we're really going to be talking about some of the differences between long-term care riders, chronic illness riders, and then also our new critical illness rider at John Hancock. So we're very excited to have with us Jennifer White, who's one of our product managers at John Hancock. She has been in the long-term care industry for about 21 years now, and been at John Hancock now. She came and then left and came back because it's such a great place, and for a total of about 7 years. So we really appreciate and we lean on her a lot for product knowledge specific to long-term care riders, and not only at John Hancock, but also kind of the industry and where the competitive landscape is currently. So she's a great resource for us and for anyone on the phone as well. Jennifer, with that, without further ado, I will just hand it over to you, and we appreciate your opportunity to speak with your producers here today.
Great. Thanks, Chris, and thanks, DC, for having me. So I'm going to spend most of the presentation talking about how living benefit riders can really help your clients prepare for the likelihood that they're going to live a long life. So the majority of this presentation is going to be spent on the living benefit riders available through John Hancock, but I did want to address kind of high level some of the differences between critical illness, chronic illness, and long-term care riders, because I know people do get confused, especially when some of them sound the same. So just, again, high level, long-term care riders and chronic illness riders are similar in what they pay for, what they pay benefit for. So both are triggered by the insured being certified as a, quote, chronically ill individual, which means they need assistance with activities of daily living, or they have a cognitive impairment. So they both have that same trigger. Qualified long-term care riders require that the care is expected to last at least 90 days. That's not what determines whether or not the benefit's paid, but that's just the expectation when somebody submits their claim. Some chronic illness riders are going to have the same type of trigger, but others will only pay if the condition the person has is expected to last the rest of the person's life. In other words, the condition has to be permanent. So we're seeing more and more chronic illness riders remove that permanency requirement, but it is definitely something that can be a differentiator between long-term care and chronic illness riders. Now, they fall under two different codes as well. Long-term care riders are classified under IRC 7702B, while chronic illness riders are classified as IRC 101G. Now, what that means is that they both can pay a tax-free benefit up to certain maximums, and we're going to kind of talk more about that as we go through the presentation. There's also a difference in how the two different types of riders can pay benefits. A long-term care rider can pay on an indemnity or a reimbursement basis, while chronic illness riders are generally just an indemnity. Lastly, long-term care riders contain certain consumer protection provisions that aren't included in chronic illness riders. Some of those are things like the protection against unintended lapse or an extension of benefits. And both of those are really in place to help insureds who may have a cognitive impairment or who have been incapacitated if their policy should lapse for one of those reasons. It allows them to reinstate it. So some really good consumer protection provisions as part of the long-term care riders, as well as any long-term care insurance that's considered tax qualified. So critical illness riders, and I'm just kind of setting the stage here, critical illness riders really have nothing to do with chronic illness or long-term care. They're very different. These are triggered by a catastrophic health event rather than an activity of daily living need or a cognitive deficiency. And we'll talk more about those as we go through the presentation. So that's just some high level to set the stage. So living a long life is a near certainty, which makes planning for it a necessity. I think many of us know that illnesses once considered fatal are now often survivable, treatable, and even recoverable. Many conditions that shorten life expectancies are now chronic conditions that are treated with medications and other types of therapies. Although this is all great news, a concern that many people have as they plan for retirement is, will I have enough? We know that many Americans are not prepared for retirement because they haven't saved. But even for those who have diligently been saving and those who are very well prepared to handle their expenses in retirement, they too could be at risk. Today we're going to focus on two issues that could derail your clients' plans to have enough for when they live a long life: a critical illness and a need for long-term care. Considering medical advances, shorter hospital stays, limited discharge planning, many of the costs and care responsibilities associated with survival fall on families, as they're shouldering them for longer periods of time and frequently with limited or reduced financial resources. Consider how a cancer diagnosis that comes during your client's peak earning years could impact their ability to continue working, keeping their day-to-day expenses while also trying to save for retirement. What impact would a need for long-term care have on even the best laid out plans for financial security in retirement? So living benefit riders can provide your clients and their families access to money at a time when they might need it most. First, let's talk about critical illness, which may be a new subject for many people on the phone. I don't know if anybody's been in the voluntary market, but typically critical illness insurance is sold through employer groups. Some life insurance policies are offering riders, but that's a fairly new offering. It's a product that's becoming more prevalent in the U.S., as many of us probably know someone who survived a bout with cancer or a heart attack. Personally, my girlfriend was supposed to take a trip to Australia for her 50th birthday, but instead she had a double mastectomy. The good news is that after her treatment, she and her daughter were able to go back to, she was able to go back to work, and her daughter were able to take the trip at age 54. And she's among the number of growing number of people living beyond a cancer diagnosis. So many illnesses like this are often survivable and recoverable, but not without cost. During recovery, your client's day-to-day expenses will likely continue and perhaps even increase due to things like coinsurance and high deductibles and experimental treatments that aren't covered by their medical plans. And this could all come at a time when their income is reduced if they are out of work, whether employed or self-employed. The critical illness benefit rider can help people afford survival. The money it provides can be used for any purpose. So it can be used to supplement lost wages, cover medical and non-medical expenses, keep a family business running, and help ensure all of their financial plans stay on track. Basically, it can help preserve their current lifestyle and preserve their future plans while they're focusing on recovery. So this is an overview of how the John Hancock Critical Illness Benefit Rider can help should your client be diagnosed with an illness such as a cancer, heart attack, or stroke. The Critical Illness Rider provides a one-time lump sum income tax-free benefit if your client is initially diagnosed with one of 7 covered critical illnesses, which we'll identify later. The benefit it pays is up to $250,000. The critical illness benefit rider is actually a separate benefit pool. So it's in addition to, rather than an acceleration of the death benefit. And this is something that's unique. I don't think there's any riders right now in the market that creates a separate benefit pool. This means the benefit, when it's paid, doesn't reduce the death benefit. So it remains intact for future insurance needs, whether to pay to beneficiaries or if they have long-term care riders, you can pay through that as well. Lastly, the money it provides can be used for any purpose, as we already said. Critical illness rider offers protection for people at a specific stage of life, which is often their accumulation phase. So not only can it help them cover day-to-day expenses if they were out of work, but it can help them maintain their savings plans, whether it's for investments, college, or for a special needs child. So let's look at more of the details. It's currently available on most all of our single life products, and it's approved in 33 states. We're continuing to work on getting state approvals. It's available to applicants who are between the ages of 18 and 65. There's no additional medical questions or requirements for underwriting. There is a brief supplemental application that must be completed, but it's really just disclosures. Clients can choose either 10% or 25% of the total face amount on the base policy as their critical illness benefit amount. So even though it's based on a percentage of face amount, it's a completely separate benefit pool. There is no cap on the policy's face amount. So if the client wants to buy like a $10 million policy and have the 25% option for critical illness, it will just be capped at a benefit of $250,000. The rider has a 30-day waiting period, which is very different from what most of you might be familiar with on long-term care, which is an elimination period. The critical illness rider waiting period begins on the date the rider becomes effective and ends 30 days later. So a benefit will not be paid for an illness that's diagnosed within the first 30 days of the person being insured. That's it. Once they go past that 30-day period, they can put in a claim for one of the covered illnesses, and it would be covered. The critical illness rider, as I mentioned, offers protection for a set period of time, which is the earlier of a benefit payment or age 65. If they purchase the rider after age 60, then they would have coverage for 5 years. And when the rider terminates, the rider charge stops. So if somebody was 40 years old, they bought the rider, they had a claim at age 45, we would pay the benefit, the rider charge would end, and the rider would terminate. Okay, this is just to illustrate a little bit about how it works. As we said, at time of application, they would elect a benefit, which is either 10% or 25% of the policy's face amount. Once it's in effect, they wait 30 days. Anytime after that 30-day period, they may be diagnosed with a heart attack, cancer, or stroke, which are the 3 most common critical illnesses that insurance companies pay claims for, as well as coronary artery bypass grafting, major organ failure, kidney failure, or paralysis. If they're diagnosed with one of those, they would submit a claim and we would pay a one-time lump sum income tax-free benefit up to whatever amount it is that they elected at the time of issue. And again, they can take the money that they get, use it for anything they need, while also keeping the death benefit intact for future insurance needs. So this is a little bit about how the John Hancock rider is different. As I mentioned, there's some other riders out there that are acceleration of death benefits. So I think most people on the call are familiar with an acceleration of death benefit. But this is how they work. They typically have no upfront charge. So they're kind of like a free rider. But they can actually end up costing clients a significant amount in their benefits if they take the offer when they need a claim. In other words, they can give up an awful lot of death benefit to receive a small critical illness benefit. In turn, many clients forego taking the benefit payment as it can be very costly to their overall insurance plans. We believe the approach we came up with creates a more meaningful benefit that will actually help clients in their time of need. If people aren't accepting a critical illness benefit payment because they feel like it's costing them so much, then it's not really doing any good. So our rider has a defined charge with a defined benefit, so clients know exactly what it's going to cost them and how much benefit they'll receive. So in addition to offering a meaningful benefit, we wanted to ensure that the other insurance needs of our customers, whether beneficiaries, estate planning, or long-term care, continue to be met. John Hancock's long-term care rider is probably our most popular. So a critical illness benefit that's a separate pool allows the death benefit to continue to be used for other purposes such as this. So now I'm going to transition to our long-term care rider, and we can talk more about that as we go. All right, so when families don't have a plan for long-term care, decisions about who will provide care and how it will be paid for are often made at a time of crisis. Families are left to determine how to afford the care that might be needed for an extended period of time. And usually when they find out how costly it might be, they often look for ways to provide the care themselves. But however, this is not without consequence. Taking care of chronically ill individuals can make healthy caregivers chronically ill. This is the nature of informal caregiving. When a spouse is left to provide care, they're oftentimes just as frail as the person they're providing the care to, risking their own health. Employed caregivers have trouble managing dual responsibilities. They often have to make changes in their work life if they can't afford to pay for outside help. Leaving a job or reducing work hours to take on more caregiving responsibilities not only puts pressure on the day-to-day finances of them and their families, but it can also have long-term consequences to the family caregiver's financial security. In addition, the emotional health of family caregivers can be negatively affected. Higher levels of stress, anxiety, depression are common among family members who care for an older relative or friend. Also, most people know caregiving responsibilities are rarely spread evenly among family members, creating even more issues at a time what is already a very stressful time. Finding long-term care coverage or even chronic illness coverage can take the responsibilities of paying or providing care off of the family's shoulders. So, as I mentioned, John Hancock has a long-term care rider. We don't have a chronic illness rider. It's not to say that chronic illness riders are bad. They just work a little different, as we talked about. The John Hancock's long-term care rider, we believe, is an affordable solution to help your clients negate the consequences associated with individuals and families paying and providing care. Here's how our rider works. If your client needs substantial assistance with 2 of 6 activities of daily living, or is diagnosed with a cognitive impairment, the death benefit can be accelerated so that they can hire professionals to provide the types of care that may be needed, rather than relying on the family to do so. This puts the family members in a more supervisory role rather than in a hands-on role, mitigating many of the consequences previously discussed. Since we reimburse for long-term care expenses incurred, whatever is not used remains in the policy and will be paid to the beneficiaries on an income tax-favored basis. If care is never needed, then the entire death benefit will be paid to the beneficiaries on a tax-favored basis as well. So we really believe that the reimbursement rider helps both plans, the one for long-term care and the one for the death benefit, execute as effectively and efficiently as possible. Lastly, the money it provides can help ensure your clients' income that they need to support their lifestyle can continue to do so. If care is needed and nothing has been allocated to pay for it, then their income that they need to live off of may need to be reallocated. So here's just to illustrate how our long-term care rider works. At the time the client applies for insurance, they elect their coverage, they're issued a life insurance policy. If long-term care benefits are used, if they're not used, whatever is remaining is paid to the beneficiary. So it's available on most of our single life permanent products. When they apply for life insurance, there is a supplemental application like our critical illness rider. However, this does have medical questions on it, and it will be underwritten separately for the long-term care rider. On the application, they also have to make two elections. The first one is how much of the policy's death benefits they want to make available for long-term care expenses. This is referred to as an accelerated benefit pool. They can choose anywhere from 1 to 100% of the policy base amount. By electing less than 100%, they can ensure a portion of the death benefit will remain for beneficiaries. The second election is how much money do they want to make available each month to pay for long-term care expenses. This is referred to as the monthly acceleration percentage. The choices are 1, 2, or 4% of the accelerated benefit pool. The most they can purchase is a $50,000 monthly benefit. Now, unlike many long-term care and chronic illness riders that pay as an indemnity, which those are capped at the IRS per diem limit, some are capped, some might pay over and above, but we'll talk a little bit more about that in a minute. Our customers determine how much they want to make available each month, so it's not tied to the IRS per diem limit. So one of the things that recently came about from the Tax Cuts and Jobs Act, I'm not sure how many people have followed it. I don't want to get too much into the weeds, but the Tax Cuts and Jobs Act offered a new indexing formula to calculate the per diem amount. So this is the per diem amount that the IRS announces every year, which means you can collect a certain number of benefits, a certain dollar amount of benefits from your long-term care or chronic illness rider or policy, and is guaranteed to be tax-free up to this amount. If anything is paid over this amount, then it could be taxable unless you're able to prove it was spent on qualified long-term care services. So the new formula that was announced results in a number that is significantly less than what the IRS announced in 2008, which was $360 per day, resulting in a monthly benefit of up to $10,800 to be paid on an income tax-free basis. The new formula results in a per diem amount of actually $250 a day, or $7,500 per month. So the new formula goes from $10,800 down to $7,500. While nothing has been announced from the IRS to indicate if this change will be made now or how this formula will be applied in the future, it does raise the question as to how carriers will respond, and when it changes, will they continue to cap the benefit at the IRS per diem limit? Or will they issue endorsements to be able to pay above and beyond the per diem amount? And how will potential tax implications be communicated and handled? So there's just a lot of outstanding questions. We don't know what's going to happen, but one of the reasons we continue to offer a reimbursement policy is that our clients will not be impacted by changes such as this. They're the ones who decide how much they want to make available each month to pay for long-term care expenses. So John Hancock has been around a long time in the long-term care industry, and we have 30 years of experience, paid more than $10 billion in long-term care claims, and it freaks a lot of people out to hear that we're paying about $4 million per day in long-term care claims. It's a lot to think about. We have over $30 billion under management to ensure that future claims are paid. So we've been doing this a long time. John Hancock continues to believe a reimbursement approach offers a number of advantages over the indemnity way of paying benefits. By reimbursing the actual costs, as I said before, both insurance plans can execute as effectively and efficiently as possible. We ensure our customers receive services from professional care providers who are licensed and qualified to provide the types of care that may be needed. We don't pay for informal caregivers. That's not the purpose of people buying coverage. It's meant to take these responsibilities off the family. John Hancock can pay care providers directly, so our customers don't have to manage paperwork or billing. And this is, I think, something that a lot of people don't understand about reimbursement contracts. I think they've been known for, oh, you have to collect receipts, you have to do your own billing, but that's not true. because we're a reimbursement company, we can receive invoices and pay invoices directly to care providers. And most of those care providers prefer working with the insurance company because they understand it a bit better than some of the insureds do. The nature of indemnity riders means invoices can't be turned over to the insurer, therefore falling on the family member or even sometimes their advisor. What are they going to do with the extra money? What does it mean to be accelerating the death benefit that might be needed for other plans down the road? So there's a lot of additional stresses that could take place by receiving more money than what is actually needed. As I mentioned earlier, long-term care benefits received from a reimbursement rider are not taxable. The policy owner sends a 1099 indicating that the benefits were paid for qualified long-term care expenses. Simple. Indemnity payments that exceed the per diem amount could be taxable. The policy owner is sent a 1099 indicating benefits were paid on a per diem basis. Then they also must complete Form 8853, and that has to be completed to determine what amount is subject to income tax, if any, by tracking how the money was spent. So with an indemnity rider, if you're collecting more, and some policies will pay over and above the per diem limit, regardless of it being reduced in future years, we don't know. But some policies will pay up to 2 times or 4% or whatever it is, and they will pay over the per diem amount. It's just now you have to track where that money has gone, or else it could be considered taxable to the insured, or the policy owner. Lastly, we offer a service called Provider Pathway, and it's a service available to any John Hancock long-term care customer, so as our rider or our standalone individual or group policyholders. It's available to them as well as their families. Their family members don't even have to have a policy. And it helps them find services, whether it's home health care, adult daycare, as well as finding incidental services like durable medical equipment or personal emergency response systems, and they help them locate these at a discount. So it helps them, not only are they helping them find services, but they are specialists in the continuum of the long-term care. So they understand kind of what families are facing at a time of need. So this is kind of an overview of our critical illness rider and our long-term care rider. So as you see, they have 2 different benefit triggers. The critical illness is based on a significant health event, an initial diagnosis of one of the 7 covered critical illnesses, versus the long-term care rider, which is based on your inability to perform activities of daily living or having a severe cognitive impairment. The benefit amount varies. So the critical illness benefit rider, 10 or 25% of the total face amount, it just pays that one-time lump sum benefit up to $250,000. The long-term care rider is a monthly acceleration, and it will continue to pay that amount up to $5,000 that the person elected, as long as the accelerated benefit pool has money available in it. The critical illness rider has a 30-day calendar day waiting period. So once the rider is issued, you wait 30 days and you just passed your waiting period. The long-term care rider has 100 days of service elimination period. So you have to incur 100 days of qualified services in order for us to begin paying benefits. So again, we already talked about taxability. The benefits for the critical illness rider are also intended to be excludable from income, another different tax code, IRS 104A3. Issue ages for the critical illness rider only goes up to age 65. Long-term care rider will go up to age 75. And lastly, as far as underwriting, the critical illness rider is underwritten as part of the life process with no additional medical requirements. It will have its own risk classification. It's available with either Express Track or full underwriting. Long-term care rider underwritten independently from morbidity. So we are going to underwrite it differently. We're going to ask different medical questions and possibly order some additional medical requirements. Okay, now this is how our living benefits can kind of work together. This is a gentleman age 55 who's buying a protection IUL policy with a $1 million death benefit. If he adds a 10% critical illness rider, it would give him a $100,000 lump sum benefit payable to him should he trigger a critical illness event. He could also add, in this case, he adds a 2% long-term care rider, which offers him $20,000 a month. And as you can see, the critical illness rider is increasing the premium. It typically, for a 10%, it's going to increase the premium anywhere from, say, 10 to 20%, depending upon, the health and the gender and some other underwriting factors. But generally speaking, it's going to add 10 to 20%. And then he elected a 2% rider. So all in all, it increased the premium about $2,500 to get $100,000 plus $20,000 a month. And of course, many of you probably know about our Vitality rider. You can also add that to help bring the premium back down, offering them additional savings, also helping them live a longer, healthier life. So in closing, these are all the different ways our living benefit riders can help you and your clients prepare for when they live a long life and help them feel more confident in planning to have enough when they do. So one thing to mention, all of our living benefit riders are fully commissionable. There is a rider charge, and it works like the LTC rider where it's dollar for dollar increases the target. It expands the type of protection you can offer your clients. Critical illness protection is a financial resource to help keep planning on track should they have a significant health event during their peak earning year. Our long-term care rider offers a financial resource to help protect income and assets in retirement that might be needed for home health care or nursing facilities. And our John Hancock and Vitality rider offers a rewards and discount for making healthy lifestyle choices. And just as important, this helps safeguard all of your assets under management. Providing a financial resource when clients need it most helps them continue paying for retirement and protect their plans in retirement. And with that, I will turn it back over to you, DC, I think.
Okay, very good. Thank you so much, Jennifer. I don't know that we have any questions. If you do have questions, give us a call at 402-330-8700 and ask for DC, and I'll make sure that I get back with you right away. The one thing that's so important about critical illness and chronic illness is that all our clients are worried about that. It's one of the main concerns today, you know, when your clients start clipping up around 50, 55 years old and over. So Hancock has something that's very different, something that brings some value, and we just did a webinar on the Vitality rider a couple of weeks ago. So all that fits together that really positions them in a unique fashion. So we're very happy with that. Chris and Jennifer, thank you so much for spending some time with us. And again, if you guys on the call, if you want to call and visit with me, call me at 402-330-8700. Ask for DC. I hope everybody has a really good day and a good weekend, and we'll hope to hear from you soon. Thanks, guys.
Thank you. Bye.
Thank you.